we're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good morning, you're watching All You Need to Know on Bloomberg Quint. I'm Darshan Mehta. Let's see what the global market had in store for us. If you're looking at the US markets, they ended with a slight negative bias. Europe across the board was trading rather weak. If you're looking at the Asian markets, they're also trading rather weak in trade. So expect a weak start from us when we open, and that's what the SGX Nifty is also indicating. The SGX Nifty is indicating a gap down of almost 30 points. We're coming in close to the 11,550 mark in trade. So for the past 2 days, we've seen heavy selling, both by the mid caps and as well as the broad, as far as the benchmark indices. Today again there will be selling that will be seen. Now as far as the ADRs are concerned, ICICI Bank was down 5%, but remember US was shut on Monday, so these ADR prices are reflective of 2 days of changes that we saw in our market. So Vedanta, HDFC Bank and Tata Motors were the other counters which were down in trade. The only exception was Dr. Reddy as well as Wipro, which managed to gain in trade. How did the broader market span out in trade? The Nifty was down 0.5%, but severe selling was seen on the mid cap and small cap. This trend was not seen on Monday, where the Nifty was down, but the mid caps and small cap end was rather flat in trade. Heavy selling was seen on the Nifty Bank on account of ICICI Bank, which was down in trade, and SBI. And PSU banking space was led down by SBI's fall that came in trade yesterday. Now, a couple of sectors in focus. IT continues to surge ahead because of how the rupee is behaving, but look at the cuts that happened in some of the sectors across the board yesterday. Media, FMCG has seen 2 days of heavy selling that's come in, and most of the FMCG stocks are down almost 8 to 9% in the past few trading sessions. How has this week been so far? It's just 2 days, but the IT is up 1.5%, but the other sectors cuts of anywhere between 4 to 5% that have already come in just 2 trading sessions. Now, as far as the flows are concerned, very minuscule flows, FIs as well as DIs. Absolutely nothing to talk about. FIs bought in 30 crores, DIs sold in 20 crores as far as as far as yesterday's trade is concerned. Basically, HDFC Bank is not contributing. SBI, ICICI Bank. So 3 large banks having high weightages both on the Nifty and the Bank Nifty, and that caused the Nifty and the Bank Nifty to fall significantly. HUL again almost down 10% from the recent highs. What managed to save the Nifty was basically the IT stocks and Reliance. If they didn't contribute, the Nifty would have been down in triple digit. That's the trend that we're seeing. As far as the F&O markets are concerned, fresh shorts were seen on the Nifty. Even if you're looking at the Bank Nifty, on high open interest build up, you're seeing fresh short positions that are being built. Now, if you're looking at positions, call writers have become much more aggressive at 10,700, 10,800. There is support coming in at 10,500 and 10,600. But if the Nifty continues this week, there will be a lot of unwinding that will come in as far as the Nifty is concerned. Even yesterday, call writers became aggressive. They wrote in at the 11,800 mark. Look at the squaring of positions on the 11,600 and 11,500 mark in trade, given the fact that the Nifty fell in trade. And again today at 11,500 and probably at the 11,600 mark, put writers again will be forced to cut positions. That's what the SGX Nifty is indicating. A couple of stocks I want to point out. Adani Enterprises is the only stock in the F&O band. The Nifty PCR, the Bank Nifty PCR, both of them dropped in trade given the fact that the market conditions were weak. 4 stocks I want to point out. The first stock is Balkrishna Industries, continues its weak trend because of the unexpected capex that fell in trade. You have Sun TV, which saw fresh shots on open interest build up of 10% in trade. Again, counters like Dabur, which were trading at record highs, have seen heavy selling, open interest build up of 19%. And finally, the last stock is Motherson Sumi, fresh shots, open interest build up of 9% on the counter.
It's been absolutely incredible. I've been watching it for those whole 3 years, and you know, he's now got a $160 billion fortune, which was big enough at the start of the year at $100 billion. And you go back a few years, it was sort of in the low tens. So and that's basically been exactly tracking Amazon's share price, which is up, I think, 74% alone this year. For a company of that size, it's pretty unprecedented.
And it's not just Bezos, but his family, who has also made out, I believe, you know, both of his parents invested in the company, his siblings invested in the company. To what end?
Yeah, it's, you know, investing in Amazon as early as they were able to. This is sort of at a share price of 20 cents a share or something, and you're now looking at over $2,000 a share. It's one of the all-time great investments. So as a family, they need no more assistance, I think. They're just trying to work out how they can give away their money fast enough to keep pace with this this great growth.
How does the speed speed with which they've accumulated this wealth compared to, other very wealthy founders like Mark Zuckerberg, like the founders of Google, like Bill Gates?
In terms of the absolute numbers, there's like no comparison. So Jeff Bezos is actually the richest person in modern history. So you go back to what Bill Gates was doing with Microsoft in sort of the early 2000s. He did hit $100 billion. That would be worth in sort of real terms today about 140, 150 billion. Bezos has blown by that. And in terms of just sheer billions being accumulated, there's really nothing in history to compare.
So, Tom, what are the risks here? He's got a lot of money. He's investing in a lot of things. He's got his philanthropic efforts. He's got his space company, Blue Origin. What are the risks once your fortune gets so large?
Well, the biggest risk for Bezos is he's just not diversified at all. Something like more than 95% of his fortune is in one stock. So in the case of Amazon, this has worked out perfectly. But when I speak to wealth advisors, they would have their head in their hands for an ordinary kind of wealthy person. They would be begging them to, hey, sell more stock, which Bezos really doesn't do apart from to fund Blue Origin, which is probably one of the few riskier things you can find out there. That is a space exploration company. So that's part of the reason he's had such mammoth returns. Just purely from a risk-reward perspective, it's very, very risky.
Well, shifting focus to Indian equity markets, stock of the day today is Muthoot Finance. Now, India's largest gold finance companies in terms of loan portfolio reported extremely good set of numbers yesterday post-market hours. If you see their top line, revenue from operations grew by 19%. It stood around 1,623 crore for the quarter went by, while net profits saw a jump of over 40% and stood around 492 crore. And now, remember, according to Bloomberg Quint expectations, we were expecting net profits to come in line in the tune of 450 crores. So there was a clear beat in the top line by the company. If you see, now this was largely on the back of lower provisions that we have seen in the quarter when by provisions dropped by around 80% in Q1 FY19. That apart, if you see their loan assets, it saw a good growth of 11% and stood around 31,000 crore mark for the quarter, while of which if we see the gold loan portfolio, which is its core business, saw good growth of 10%, which is almost a double-digit growth that we have seen after 2-3 quarters, and it stood around 30,562 crores. Talking about the asset quality trend for Q1 FY19, asset quality has improved substantially. If you see from past 2 quarters, it stood around 4.56% as compared to 6.98% sequentially. Talking about 2 of its subsidiaries, first, its home finance business, its loan portfolio saw a good growth of 172%, which stood around 1,621 crore. However, there was a bit of a downtake. If you see their gross NPA numbers, deteriorated a bit from 0.42 to 0.51% in Q1 FY19. And lastly, if you look at their insurance business, it saw a good growth in their first year premium collection, which rose almost 200% to 49 crore, and also net profits doubled to 2 crore for Q1 FY19.
Let's also get your check on the commodities and currency space, starting off with oil prices, which are seeing some bit of softness come about, nearly 0.5% down for the WTI, and Brent is currently down about 0.3 to 0.2%. Now, there are a couple of factors that are weighing in on the oil markets, which is the stronger dollar and the inventory data that is expected. So, Cushing crude oil inventory is likely to increase as much as 6 lakh barrels for last week, as per a Bloomberg survey, while the total US inventory is likely to decline as much as 2.75 million barrels for last week. But both of these are just as a survey, but we'll have to wait and watch how the actual data in fact comes out. Shifting focus to the base metal space, the LME base metal index declined the most since August 15 and ended sharply lower by about 2%. Nickel hit a 7-month low on the back of the dollar index, impacting all the base metals. In fact, China's nickel ore inventory came in at the highest level since December 2016, and copper declined to its lowest level since August 15th as well. And we had the other likes of aluminium, zinc, lead, and tin, which also declined on the London Metal Exchange. And if you have a look at the Shanghai Futures Exchange, the base metals have in fact extended their decline, with copper, zinc and aluminium trading more than 1% lower, and Shanghai Steel about 0.5% lower. Similar was the case with gold prices as well, which saw the biggest decline in over a week, once again impacted by the dollar index. With that, let's shift focus to Saloni Dhanuka, who will tell us more about the currency space. Morning, Saloni.
Good morning, Jayesh. So, talking about Indian rupee, it crashed to yet another historic low yesterday. It ended 0.5% lower versus the dollar at 71.57 levels against the dollar. Now, remember, this was the fifth consecutive decline for rupee yesterday. If you see, so far this year, the home currency has depreciated almost 11%, thereby making it the worst performing Asian currency so far this year. Concerns over rising crude oil prices, along with strong dollar demand from importers amid trade tensions between emerging markets, has been weighing on rupee of late. Well, talking about bond markets, sovereign bonds extended decline for the 7th straight session yesterday, as we have seen yields rising to its highest level in more than 3.5 years. The 10-year benchmark bond yield rose 6 basis points yesterday to end at 8.06%. On the global front, the dollar index ended 0.3% higher, and it now trades well above the 95.4 mark in the early Asian hours. Dollar yesterday was largely supported after the release of economic data. Its manufacturing activity jumped to a 14-year high, and it came in better than expectations. It stood around 61.3 mark. Well, also helping the dollar was a weaker pound and euro, as Brexit-related worries and weaker UK construction largely weighed on pound yesterday. And lastly, if you see dollar rupee now, it is trading at 71.60 levels against the dollar in the non-deliverable forward markets, which indicates a flat to weak opening for Indian rupee in today's trade.
Well, amongst the stocks that we are tracking in trade today includes Sun Pharma Advanced Research, which has released a deadline for FDA to review its 2 drugs. So the deadline for Cellpros and Ellipsia has been set at November 2018 and Jan 2019. The company has also said that they will be filing a new drug application for the cancer drug Taclantis in Q4 FY19. Sorry, so that's one stock to watch out for. Next on our list is Indigo, which might possibly be in focus, and that is on the back of comments coming from Qatar Airways CEO, who has said that he won't rule out any future opportunity to invest in Indigo. Nevertheless, they have said that they're open to partnership with any financially sound and credible partner in India. So watch out for Indigo on the back of this development. Then you have McNally Bharat Engineering. They've received an order worth 108 crores from NLC India. This will be completed over a period of 24 months. It's a smaller order, but sizable for this company, given that its market cap itself stands at about 340 crores or so. And lastly, you have MEP Infra Developers, where the promoter in a bulk deal has picked up 0.5% stake. So that will take the stake of the promoter stakes to that 61.92% as of 30th June. So some positive cue in this one as well.
You've also taken over the reins of the USIBC at a very challenging time, if I may say so, when the US is looking at Make America Great Again. India is looking at Make in India. Both sides are focusing more on, internal domestic audiences and trade. How do you reconcile the idea of Make America Great Again and Make in India when you're trying to move forward on your agenda?
Well, I actually don't think that the two are incompatible. I think that we can create the kind of opportunities that both allow for the creation of jobs and manufacturing in India and see India as a vital cog in the global supply chain, and at the same time create opportunity in the United States. So I think we have plenty of scope for developing win-win solutions and for developing industries that reinforce each other in both countries. I'm seeing a surge in Indian investment in the United States, just as we are also seeing growth in U.S. investment in India. And that, I think, captures the opportunity.
Let's come to a few of the specifics of what we're seeing right now in the relationship, trade relations between the two countries. We have a set of tariffs from the United States. India has its own list, though it hasn't been actioned yet. Do you see these as major stumbling blocks?
Well, it's definitely not helpful when either side starts erecting trade barriers and launching tariffs. USIBC and the U.S. Chamber stand firmly for free enterprise and for free trade, because we believe that industry thrives, consumers benefit, and the economy grows when you open up the economy and when you start looking at the global ecosystem rather than erecting barriers to protect your own industry and your own economy. That said, I do think that we have an opportunity through all of these trade discussions and negotiations to try to reach some understandings and accommodations between our two countries.
On the big brokerage calls for the day, first we have is Nomura on Cochin Shipyard. Now the brokerage has initiated coverage on the stock with a buy rating and a target price of 534, which suggests a potential upside of nearly 28%. Now Nomura sees a strong medium-term visibility on the company on the back of the defense order and ramp up in ship repairing segment. And on the back of this, the brokerage is expecting the company's revenue and EBITDA to grow at a compounded annual growth rate of 15% and 18% over FY18 to FY21. Now going forward, Nomura sees an addressable defense opportunity worth more than 1 lakh crore rupees over the next 5 years, and of these total orders it is expecting Cochin Shipyard to bag orders worth nearly 24,000 crore rupees, which would extend the revenue visibility on the company until financial year 2030. Lastly, the brokerage says that it is assigning a higher valuation multiple to Cochin Shipyard on the back of its strong growth outlook and a superior return on equity profile. Second we have is HDFC Securities on HG Infra. Now the brokerage has initiated coverage on the stock with a buy rating and a target price of 386, which suggests a potential upside of nearly 61.5%. Now, according to the brokerage, NHAI ordering is expected to further pick up in the second half of financial year 2019, which will in turn address the longevity concerns on the earnings upcycle for the company. Now, when it comes to HG Infra, healthy balance sheet, stable working capital cycle, and entry into HAM projects are the positives and the key catalysts for the company. And on the back of this, the brokerage is expecting the company's order book, revenue, and net profit to grow at a compounded annual growth rate of 32%, 35%, and 38% over FY18 to FY20. Now, along with this, more subcontracting projects are expected to boost the margins of the company going forward. Lastly, the brokerage says that a firm grip over the working capital and debt would help the company deliver a return on equity which is higher than 20% plus.
All right, if you log on to the website www.bloombergquint.com, you'll find right on the top there's a story called All You Need to Know Going to Trade this Wednesday that will give you a comprehensive sense of what to expect when you enter the markets this morning. But apart from that, there are several stories that you might be interested in reading. Here are just a couple of them. A joint venture between Anil Ambani's Reliance Infrastructure and Italy's Astaldi SPA expects to begin work on the second leg of Mumbai's Sea Link by October. And the LIC board on Tuesday approved increasing its stake to 51% in state-owned IDBI Bank. The life insurer is also exploring whether it should make an open offer or seek an exemption. That's all you need to know going into trade today. Up next is Indian Open, so do stay tuned. This is Bloomberg Quint.
Anything and everything about your investments. We're just